I'm starting off with a daily chart of the NASDAQ Composite, and I just want to review what I discussed last month. At the end of March, early April, I talked about how technology could start to participate with new money coming in beginning of the month, beginning of the quarter, anticipation of a run-up into earnings. And I even discussed it several times through this product and also mentioned it in a Yahoo Finance article. And here is the Yahoo Finance article where I said we could see a rally that could take the NASDAQ Composite back to new highs and the S&P 500 to 4,200. So going back to the NASDAQ, the good news is since that time, the NASDAQ did have a strong run and made a run back above 14,000 towards those highs. And the other good news is that the S&P 500, right when it was around 3950 or so, did make a run to 4,200. So I'm not saying that to brag. I'm saying that that's the great news. The bad news is sort of the elephant in the room we need to discuss, which is beneath the surface, a lot of growth stocks struggled. So the call was great on the indexes, but to be perfectly honest, it has been a very difficult environment for growth traders. We haven't seen any sustained moves. It's been a lot of chop and churning and nothing really, any sort of consistency. And that's been a challenge, especially not just for growth traders, but small cap growth. I've talked about the IWO, which is one of the ETFs for the Russell 2000, just the growth section of the Russell 2000. And you can see that it barely made any progress this month and really hasn't made any progress over the last couple of months. Even ARKK, which I've talked about, I'm not picking on Cathie Wood and ARK Innovation, one of their flagship ETFs. I'm just making the point that this was actually down for the month and is down over 24% from its highs and has really struggled. And this is a concentrated group of really, strong quality growth stocks. So again, the indexes went higher because of sector rotation, but beneath the surface, it has been a very difficult and challenging environment for growth stock traders. So the way I look at it is one of two things happens. Either, going back to the NASDAQ, either growth stocks start to stabilize and they start to move higher and that brings the indexes higher, or the second possibility is the weakness beneath the surface will eventually bring the indexes down, and I'm leaning towards that latter scenario for the following reasons. Let me go back to the S&P 500 to show you. First and foremost, so basically to sum up what I'm going to say is I'm expecting a 4 to 6%, a normal pullback, but sort of a minor correction in the S&P 500 in the markets over the next couple of months. That's basically just to give you get to the point of what I'm going to say. Now, first and foremost is that I did not like the reaction to a lot of the mega cap company earnings. As I always say, it's not the news, it's the reaction to the news. Apple was supposed to do $77 billion roughly in revenues. They did $89 billion, which is ridiculous, but that's beside the point. If you hypothetically had some of these earnings reports in advance, you never would have imagined how many of them would have fizzled out, closed negative, or gapped down. Apple had amazing numbers. It ended up reversing and came back down here. Microsoft, another one this week. Killer numbers, gap down on those killer numbers. You're talking about a company that's close to $2 trillion in market cap, growing their revenues with an uptick in revenues, growing their earnings and sales, and it went down. Amazon, another ridiculous quarter, gapped up and then reversed and closed negative on Friday. Tesla was another company that had great earnings. Everyone's saying, well, Tesla doesn't earn any money, and now they're starting to earn money, and this thing sold off. I know it bounced back on Friday, but overall it's been weak. A line outside of big tech, another monster number beat and raised, gapped up and completely gave that back. And then also before last week, Netflix, the same thing. Everyone's saying Netflix doesn't make any money. Now they're cash flow positive, and they're sort of opening up their profit margins, and they killed the estimates, but their subscriber estimates were weaker than expected. So this thing gapped down below its 200-day. Also, a couple weeks ago, Micron beat their numbers, and it drifted up a little bit, guided higher, and then it's just done nothing but tick down below its 50-day. Now, I know I'm not just only bringing you the negative ones. I know there are a couple that reacted well. Facebook reacted well, and Alphabet, the parent company of Google, reacted well. My feeling is that probably because they're the least owned of all the FANG names, but that's just a theory. But the first and foremost, I did not like the reaction. The bottom line is it just showed me overall selling into strength by the big institutions. So that is one reason I'm cautious. Second reason, going back to the NASDAQ, is that May and June are traditionally difficult months, especially the second half of June. So that's why my call is that the gains from April will most likely be given back over the next couple of months, where you might have some sell in May as you head into June. After next week, I think 80-something% of the S&P 500 companies will have reported. So that's when we start to head into no man's land, especially the third month of the quarter, March, June, and September specifically. So the news shifts from, hey, let's look forward to Amazon's earnings. Let's look forward to Apple's earnings. It shifts into politics, interest rates, geopolitical BS, as I talk about. So the news cycle will shift to that as we start to head into the summer doldrums. Hopefully I'm not depressing you too much. I'm just trying to present what I'm thinking here. Speaking of interest rates, the 10-year has been going up. It held its 50-day. This is a chart of the 10-year. I could see that if the economy's coming back, I could see the rates going back to these levels, January of 2020, before the pandemic, if the economy's coming back, which would bring the 10-year closer to 2%, which is still historically low. However, that affects multiples of growth stocks, especially some of the high growth stocks. So the valuations could continue to get hit. Just something to keep in mind. Tax selling, as I talked about, here in the U.S., because I know there's a lot of international members. Tax day is April 15th. It was delayed a month, and Monday, May 17th is when taxes are due. A lot of people have great gains from last year. So whether they sell this week, I'm guessing the second week of May, they're going to start to sell some stocks, is my guess, to raise money to pay their tax bill. So that's another thing. Again, we take this day by day. It's something else I'm thinking about. Sentiment, as I always say, is a secondary measure. NAIM is back at almost 104, so a lot of active managers are on margin. That's just from a contrarian point of view, not the greatest thing. There are other sentiment indicators that are showing, moderate bullishness, not extreme, but nevertheless, there's some that are showing pretty high levels of bullishness. I also discussed tax increases. There could be some headlines as the new administration is trying to propose higher taxes. I don't think some of the capital gains levels that they're proposing are going to end up getting passed, but those headlines, as we saw a couple weeks ago, could scare the markets. Also, the average, let me go back to the S&P 500. The average, I'm almost done with my points, by the way. The average intra-year decline is 14.5% intra-year decline on average. We are up 11% on the S&P roughly for the year. The average S&P gain is, call it 8 to 10%. So we're above pace for a full year gain. Now, that doesn't mean we have to decline. I'm just saying that, if we're going to save some for later in the year, it would make sense to at least pull back or go sideways or digest some of these gains. Just something statistically to keep in mind. Great. One of the objectives of this product is to keep you on the right side of the market. It's been a strong market overall. A lot of ETFs. Some sectors have been doing very well. Again, growth has been shaky, but I just want to try to just be a little bit proactive, anticipatory, if that's the right word, and just give you a heads up from a risk-reward standpoint. It's not the greatest right now. So, now that I've depressed everybody, let me make a few positive points. First and foremost, I am not bearish. I am just cautious here. That's it. From a risk reward point of view, I'm just cautious that keep in mind, we can't go straight up every single day. You're going to have normal price action. As I said, those normal visits to the 50-day. And my call is that over the next couple of months, we're just going to come down maybe when I reset the lines to retest that 50-day or even retest this, below 4,000 roughly that we broke out from at the end of March. Now, the second thing I want to say is I could be wrong. I'm wrong all the time. I'm just going by what my instincts and from what watching price action and years of experience is telling me. I could be wrong. One other scenario I did talk about earlier in this video, that one scenario could be growth stocks could stabilize and then we could launch higher. So that's a possibility. Another possibility is we just go sideways because of sector rotation and we don't correct. And maybe over the next couple of months, we catch up to the 50-day. That's a possibility too. I'm open-minded. And again, we'll take this day by day. The other thing I want to make a point is I'm not saying sell everything on Monday. I'm not saying we're going to drop to the 50-day on Monday. I'm saying over the next couple of months, for people with that type of time frame. I just want to sort of give you my thoughts on that. Another positive, there's still a lot of stocks acting well, which I'm going to get into later in this video. And then obviously another huge positive is the Fed. They're not raising rates. They are continuing with their bond buying. It's providing a tremendous equity-friendly backdrop for the markets. That doesn't mean we can't have pullbacks and corrections along the way. They've been equity-friendly for a while since, the pandemic, since they had all those announcements in late March of 2020. That doesn't mean we haven't had pullbacks and corrections along the way. So just because the Fed's on our side, it doesn't mean it's a straight line up. But it also doesn't mean I'm not seeing anything sustained. Again, just a normal pullback is what I'm expecting. So I'm sure your next question is what to do. I would definitely decrease position size. Me personally, about average position size is about 5%. I've cut some of them down to 2 or 2.5%. That way, if I am wrong and we go higher, you can still participate. But if things pull back, you don't get hit as bad. So decrease your position size. Definitely minimize some new buys, because if you are going to take some new buys, smaller positions, because breakouts are not working and a lot of things are failing, which I'll also get into in a second. I would get off a margin, because one thing I will say is if we do pull back, I do have a lot of cash right now. If we do pull back, I'm still bullish. I'm just going to look to put money to work on the pullback. So it'd be nice if you're on margin to have some cash in case we do get that pullback. And then also, you got to stop yourself out on any stocks that are decisively below the 10-week, just to at least cut your losses on those. Again, this is where I encourage members to make decisions. Some members have longer-term time frames. They might even really understand and believe in a story longer term, and that's fine. But if you're going to hold something below its 10-week, just understand you have to be very, very patient while it builds its base. So basically, this is going to require some patience. This is going to require some discipline. There are times to step on the gas. There are times to ease up. And I'm just saying this is one of those times based on my instincts and from what I'm seeing, one of those times to ease up a little bit. But the good news is that if we do get the pullback, I'll be here to show you the strong stocks holding up and the ones we can pounce on that'll show great relative strength, because I'm still, to repeat, overall bullish, just short-term cautious. So